welcome to a Chartsarefun weekly session. This is for the last session of the year, recording this on December 28th in the afternoon. First of all, happy holidays to everyone. This has been quite an exciting year for the bulls. We'll look through kind of the market overview for 2025. And then there's been strong forecast for a continued bullish move in 2026. We'll look at some of what the Wall Street key banks are saying, and then kind of talk about a little bit of what we think could be happening with the S&P 500 and the QQQ, and end with that. So with that, without further ado, our website is Charts are Fun. This is our blog site in Substack, chartsarefun.substack.com. And our YouTube site is also Charts are Fun. That's our channel. We appreciate you subscribing to the channel. And if you like the videos, if you could hit the like button, we really appreciate that. So if you look at 2025, and this is year to date, mapping out the core ETFs. So we have the leading performer this year at 170% gain, which is more than twice X, right? 100% is twice X, is almost nearing towards 3X, 2.7X multiplying factor is silver, SLV. So that's by far the best ETF. Then right below, quite far away from 170% at 72% is gold, GLD. And then we have emerging markets, EEM, that's the MSCI Emerging Market ETF, that's at up 34%. The Magnificent Seven, this is a ETF called MAGS, which is the Magnificent Seven stocks. That does not, count Broadcom or Netflix. These are the top trillion market cap companies with respect to the Nvidia being the number one, Microsoft, Apple, those are the top three. And then we've got Google and Amazon, the next two, and then Meta and Tesla. So those are really the Magnificent Seven that we're talking about. That's performed at 25% almost year to date, and then QQQ has been pretty much right in line because it's pretty much dominated by the Magnificent Seven, is at 22.66, and S&P 500 at little less than 20% at 19%, and then the Dow Jones has been a bit of a laggard. That's of course the mega cap, bigger top 30 stocks. That's at 16%, and then TLT, which is the 20-year Treasury ETF, at 4.9%, and then the dollar and the Bitcoin have been negatives for the year. Dollar, as in the ETF UUP, and the Bitcoins. There are multiple ETFs. In this case, we're doing the grayscale, the GBTC, at down 7.5% for the year. So if you start at how the year started off, we can see right at the top of the gate, Bitcoin started leading in January. That's in light gray color. So we can see that that was the leader. Turned out to be complete flip by end of the year. It's at the laggard and the worst performer for the year so far. Now, if you look at through August, pretty much Bitcoin maintained at towards the top with gold and silver. So gold and silver here, gold in blue and silver in black, were pretty much leading after from the beginning, from February onwards. We can see that the gold and the silver have been towards the top end. So from February onwards, they've been at the top end. Bitcoin kind of followed along till the point where Bitcoin then from February going into April did start lagging. And then by the time came into July into August, Bitcoin kind of made up and kind of came up very close to where silver and gold were, till the point where Bitcoin again made a high that the October timeframe, but by that time was significantly underperforming silver and gold. And we can see that silver and gold from the point in August took off, went parabolic. Silver in particular started leading all the way from August and never looked back. And right into last part of December here, we see silver up 170%. Gold also had a big climb, up 73%, 72% for the year, but started lagging silver after the the initial part in October. From October onwards, they both came close to matching performance at about that 70% or so, and from there silver took off and gold kind of lagged silver. Now, the other part that has steadily done well throughout most of the year is emerging markets, EEM. That's the third performing ETF here. And we can see starting off from the recovery from the tariff lows in April, it kind of came back up. This is in the brown color performance of EEM, the MSCI emerging market. And we can see that it's steadily maintained at the 30% plus gains year to date through all of September into towards the end of the year. So that's the third performing. The two key that kind of were right in line for the last few months was QQQ in magenta and the Mag 7 ETF Mag S in green. We can see that the Mag 7 ETF was the worst performer in the tariff low in April. So around that April 7th, April 8th low, we can see the green was the worst performing. It had a double bottom test at late April into early April. And from there, it started recovering. And then to the point where green now is at 24.9, 25%, right in line with the magenta being QQQ. So that cluster, in this case, the green and the magenta, the QQQ and the MAGS, kind of shows us how MAGS, the AI related trade, has dominated the tech sector and dominated QQQ as a result. The key is Bitcoin. From that October high, we can see how it is definitely lagged off. And in many ways, people could say that starting from that August timeframe when Bitcoin, silver, and gold were at similar gains, somewhere around the 40%, how money could have rotated out of cryptos into precious metals, into gold and silver. And that could basically have caused this massive climb. In particular, silver has been just outstanding. It's just amazing how it has vertically gone up. So now talking about that, if you take a very long-term chart of silver, this is a quarterly, each candle is a quarter, and this goes back all the way to early 70 from 1970. So looking at a 55-year time frame, we can see a beautiful cup and handle on the very long-term horizon of silver. So this is the spot silver price, not the ETF SLV, but this dollar silver, which is the spot silver. And we can see that from the level of 49, it tested twice, 49.45, 49.51. So those were the parabolic peaks we got into 1980 and then into 2011. Then it formed a kind of a cup, kind of a 49 all the way down to 3.5 up to 49.5. So that's a cup, and then a handle pullback from 49.5 to 11.6, which is the 2020 COVID low. From there, we had the multi-year breakout. On that multi-year breakout, if you take the depth of the cup from 3.5 to 49.5, you're talking about roughly $46 is the depth of the cup. At 46 to 49.5, we are talking about 95.5. So that's where we think silver is headed. We are almost there. We are within 20% of that. We closed at 79. So 79 to 95, we're talking about $16 additional upside, and that could take silver towards that 95 target. So that's what we're looking at. We, of course, see RSI at extremely overbought level on this quarterly chart, RSI at 87.5. So that's extreme overbought, but potentially the momentum is there, and for silver to get there in terms of the spot silver to get to 95 could come in the next few weeks, if not days. That's the momentum right now chasing this higher. So that's where silver is. That said, there's extreme bearish sentiment on the dollar. People think that king dollar has lost its status. Money out of central banks around the world is moving out of dollar treasuries into precious metals, and that's what's causing gold in particular to climb up. Significant accumulation of, diversification and accumulation of treasuries of the respective countries into gold. But if you look at the longer term, similar kind of quarterly chart, every candle here is a quarter across the multi-year time horizon, going back to 1971. This is in stock charts, dollar USD. It's a market basket of currencies against which the dollar is charted out. We can see a nice rising channel pattern along which dollar has been climbing since its 2008 bottom. So that does not look bearish at all to us. If any, we feel that dollar is testing a key level, which is the lower end of that rising channel at 96. Also, if you look at the 50 above the 200, that's preparing for a golden cross. Right now, the 50 and the 200 are right at spot on at 96.48, 96.49. It's poised with the 50 climbing higher, the 50 period moving average climbing higher above the 200, which means the trend is very much bullish and continues to be bullish on the dollar as far as we are concerned. So while the world thinks that the dollar is losing its reserve currency status and is the most bearish currency potentially looking forward, we disagree. We feel dollar is going to resume its climb. It's going to quietly put in a decent rally and looking for the next quarter, in fact, the next several quarters into 2026, we may not see as much of a bearish pattern and further drop. In fact, we feel this has been a key support level at 96 that USD has held. We expect it, if you think of this as a cup and handle, higher brim on the left brim at 121, pull down to 70, up to 114. So depth of this cup taking the right brim, 70 to 114, we're talking about 44. So at 44 to 114, we're talking about 158 level is where we think USD could climb up to, which is going to go back and retest that 1985 kind of highs, which is 164, but kind of that was a spike candle, but by the end of the close, it was somewhere around that 150 level. So we feel that with 150 to 160 is where we think USD could climb, and we are, as a result, extremely bullish on the dollar and feel that dollar will continue to have upside into the years ahead. That said, that could typically inversely correlate with commodities. And while people have been extremely bullish on commodities, CRB index is the one of the core commodity index that people look at. And if I look at the CRB index chart, that has had a V-sharp climb from that COVID low at 101 to 329. It's since then been consolidating. But look at what the PPO chart is telling us. PPO is setting up for a bearish cross. The signal line black is setting to cross below the moving average line in red. The histogram is dipping, getting very close to dip below the zero line. That together from this bearish cross of the PPO indicates potentially downside. Now, precious metals are only 7% of the CRB index. If you look at the bulk of the CRB index, kind of 80% composes of the energy, which is the oil, natural gas, and so on, those features, and the agricultural commodities. Those by far together are the bulk of, so it's like 41%, 39% together, 80% is what those are. 7% is the precious metals, and then the remaining, you would say 13% or so is the basic materials. These are like the nickel and aluminum and so on. So that's how the CRB index is composed of. And the fact that this is kind of had a counter trend move and from there is not able to take out the 2022 high at 329, the lower high, we can see that PPO is getting ready for a bearish cross. We expect a downside movement. We know that the crude oil has already been, has pulled back a lot from over 90 a barrel to hovering below the 70 a barrel in the closer to the 60s. And so energy has been downward sliding anyway, and so has agricultural commodities. They've not been at the top either. They're significantly away from their peaks. We feel the basic materials, which to some of them like copper and others have had some upside, and in particular precious metals. Precious metals are across the complex. We're not just talking about silver and gold. Palladium, platinum, silver, gold, all four have had outstanding gains. I mean, you're talking about have all more than doubled in 2025. So we think that there is going to be kind of a pullback coming into that precious metal sector, and this CRB index kind of having that bearish cross of the PPO as an indication that the dollar could resume its climb and precious metals could take a sell-off and come lower into 2026 is where we are seeing this. Now, talking about Wall Street's predictions for 2026. This is a tweet that was put out by Leverage Shares, and we can show a nice plot showing upper headed arrows. Deutsche Bank by far has the biggest prediction in terms of upside over 8,000. We can see that this arrow ends above closer to 8,000. And the most bearish forecast is Savita Subramanian from Bank of America. Her forecast is closer towards the 7,200. On average, it's still 10% above from where we are right now, near 7,000 to 7,600 to 7,700. So even Tom Lee, the Perma bull, who's been extremely bullish about the stock market in general, is expecting 10% upside next year towards a 7,700 target. So we can see that Deutsche Bank is the one that has almost, 20% upside expected again into 2026. Morgan Stanley is right behind, and then the others are kind of scattered lower in that, but still all expecting an upward trending year into 2026. That said, if you look at where we think S&P could have trajectory in the next several months, we're looking at the indicator, which is the market breadth with respect to percent of S&P stocks above their 200-day moving average. 200-day moving average by technicians are considered a big demarcation of above the 200 things are bullish, below the 200 things are bearish. So what percentage of S&P stocks are above the 200-day moving average now? We can see that this is forming a dome-shaped pattern, starting off with when only 10% of the S&P stocks, 500 stocks were above the 200-day moving average in the 2022 low. That went up to 77 into 2023, fell back to 23, then a higher high at 86 around the 2024. Now the market is at all-time highs close to 7,000. Look at that lower low in the market's bullish indication in terms of its market spread. It came up to 71 in the August timeframe, and since then it's been deteriorating into lower highs. So this dome-shaped pattern, if you join up the peaks, is basically predicting a downward slope into 2026, lower highs, lower lows. So we've hit 56, 50. I would expect in the first quarter next year, 2026, we will see a level of S&P 500 above their 200 moving average. That's basically in stock charts printed as dollar SPX, A is in above, 200 is a 200-day moving average. That's the SPX A200R is what that moving average indicator is. I would expect a lower low from the 50 level that we saw in the November pullback. So that means that if this, and we've already had a bearish cross of the blue, which is a 50 period moving average below the 200-day moving average. And that's flattening out, but expect the 50 period moving average to begin declining, and would expect something like what happened in the 2022 timeframe happen repeat in 2026, 4 years later. So we can see that this cycle kind of goes up from the like low double digits from 10 to 70s, pulls back to 23, back to the 86, pulls back to 15 in April, and by the next year, middle of next year, we expect this number to come back down towards 20 or lower is what we think, and that would mean S&P to have downside. Also, complacency as indicated through VIX, which is the put call ratio in terms of not just the ratio, it's basically puts and calls outstanding out in the S&P 500. That as volatility indicators also printed a lower low for the year towards the end of the year. The lowest was 14.12 in the August into September timeframe. We printed 13 handles. It has hit 13.38 in the most recent week, last week. So that's printing lower low, but look at where the MACD is printing, it's at a higher low. So that's positive divergence. VIX printing a low level at a higher low from a MACD indicates we could be setting up. And also look at the longer term trend line from a moving average. The 50 is in blue, the 200 is in red. 50 has come very close to kind of start going over the 200 like we saw in the 2022 timeframe. It has kind of touched each other. It came from below the blue, touched the red, and since then has been hugging each other. But I would expect this now for the 50 to climb higher as volatility picks up. So we expect 2026 first half definitely to have volatility. Expect the 50 period moving average of VIX to start climbing as VIX shoots higher. And that's something for us, the red herring that very few people are looking at, potentially thinking that, oh, there's going to be all these great Trump administration tax breaks coming into the economy and so on. But remember, there are some kind of outliers out there, concerns. There is Supreme Court's decision on the tariffs coming out in the first quarter next year. There's also the key Fed chief decision. The next FOMC chair will be announced by President Trump early into 2026. Market may not like the decision. Right now, there's a very good chance that Trump's going to pick someone who he believes is going to be dovish, who's going to continue cutting rates, and he's been very explicit even in his Truth Social posts about a Fed chief that keeps the economy chugging along, and it kind of stimulates the economy to lower rates. So that's what his goal is going to be. Market may not like a non-independent Fed chief, someone who's going to bow to the president and make decisions based on his whims and calls. As a result, we could expect to see volatility. Market may kind of sell off with the announcement of the Fed chief. So that's something for us to look into. So with that said, VIX could begin to climb, and the VIX for Nasdaq, which is VXN, this the Nasdaq 100 volatility is also to us printing. We can see that it's kind of at the lower end of the multi-year range at near that. It typically trades between 15 to 40. That's where it's traded over. But look at the 50 period moving average in blue getting ready to test the 200 and maybe cross higher. And that also, as you can see, as the retest of the levels near the 16s, we had a 1709, has not yet broken below the August low at 16049. But as it's getting close to retest that level, we can see a higher low in MACD, in VXN, just as much as in VIX. So volatility for both NASDAQ 100 and volatility for VIX, which is the overall, S&P 500 VIX, are both printing higher lows in MACD, indicating positive divergence, indicating potentially higher volatility ahead. So with that, let's look at the S&P 500 daily chart. And what that's showing us is classic negative divergence. We can see a dome-shaped top pattern here. By the way, there is in the longer term forecast of S&P, if you look at the 61.47 down to 48.35 to the 60.59 level. So that's a kind of a cup and then a shallow handle and a breakout with a gap. That measure target from 48.35 to a 60.60, you're talking about 1,225 points. At 1,225 to 60.60, you're talking about 72.85. So that's the target that the cup and handle on this daily chart is pointing. And then if you look at a 65.21 to a 69.03, you're talking about roughly 380 points. At 380 to 69.03, that's 72.80. So 72.85 is on this cup and handle, 72.85 on this inverse head and shoulder. You could call that as a neckline right there. A left shoulder at 66.31, the head at 65.21, and then the right shoulder at 67.20. That breakout from this inverse head and shoulder measures to 72.85, 72.80 as this cup and handle on the first part of the year is. So that's potentially where we think S&P on the bullish side could get. That's the maximum upside. But that said, as S&P is climbing a higher high, tested a higher high last week at 69.45. Look at where RSI is not printing any higher highs. RSI is like weakening over the last 5-6 months. We can see at a much higher RSI in the July timeframe, a lower high in RSI in the September timeframe, coming into October, a further lower high into November, and now into December. RSI is beginning to weaken, and so is MACD. We can see MACD is weakening as well. This is classic negative divergence, and we could just be forming this dome-shaped top somewhere in that below 7,000 level, and from there break down is a distinct possibility. So while there is the max upside that we could see here is if you get this inverse head and shoulder breakout towards that 72.83, 72.85 level, and that's corroborated by this inverse head and shoulder in the last 2 months, and this cup and handle from 61.47, 48.35 to 6,060. So both of them measured in that 72.85 is potentially where S&P could go, but we could just top out here from this negative divergence and break below. And if you do break below a 65.20 to a 69, 40 or so, talking about 420 points, subtract 420 from 65.20, you're talking about 6,100 is easily where, will now be big support as what was resistance from the February high before the market broke down from the tariff lows. So 6100 is potentially where a pullback of S&P could definitely emanate in the first half of next year is what we're thinking is a good possibility for 2026. QQQ, the Nasdaq 100, also has negative divergence, climbing higher highs, but look at RSI printing lower highs. Look at MACD printing lower highs. So there's negative divergence in the Nasdaq 100 ETF QQQ chart as well. And we believe here the max upside we could get is a similar kind of an inverse head and shoulder a neckline around 626 to 628, left shoulder at 597, a head at 580, and then a right shoulder at 599. So if you do a 580 to 628, you're talking about roughly 48 points at 48 to 628. So that's 676. That's the upside potentially that QQQ could go in the best case from where we are at 623 that it closed on Friday. Also, there is a cup and handle pattern here as well from 538, came down to 400, came up here around, if you hover around the mouse here, the cup tip of the right brim of the cup is around 535. So if you're talking about 535 to 400, it's about 135 points, at 135 to 535, 670. So this cup and handle is 670, this inverse head and shoulder is 676. That's the upside on QQQ max, is we could get up to 670 to 676 and then top out. That said, there's a good chance that we may not get that far. This negative divergence may way over, and into early next year, we might start getting a sell-off. And that breakdown from a 579 to a 636, you're talking about roughly 56 points. 56 subtracted from 580, you're talking about closer to 524 is where we think we could get a test, which is 538 was now going to be resistance, but somewhere in that 521 was the right this peak here. So in that 520 to 530 is where we could get a pullback in the QQQ if this breakdown happens. So with that, to sum it up, this has been an awesome year for precious metals. Silver gaining 170%, gold at 72. These two definitely kind of dominating the year. A distinct far away third is emerging market EEM. The Max 7s and the QQQ are at near 25, 23%. S&P is below 20 at 19%. Dow Jones is at 16% or so. And then the laggards have been the TLT, which has been a defensive at 4.95%. And then the two negatives for the year, the dollar ETF has been down minus kind of 5.2%, and the Bitcoin ETF has been down over 7% negative. So those are the two negatives, the dollar ETF and Bitcoin, and the rest of them kind of clustered in that 16 to 25%, emerging market at 35, and then gold and silver dominating. Silver on a very long-term chart, this is a quarterly chart, is showing a very bullish cup and handle breakout above that key 49 level. So from a 3.5 to 49, you're talking about $46. At 46 to 49.5, that's 95.5. So that's where we think the upside target is, not too far from where we are now. At 79, another 20 points, adding 16 to it could get us to 45. So 20% upside we think is remaining in silver with the momentum that we have seen. Look at what just happened in the last quarter. 69%, 70% climb in silver in just the last quarter itself. And so we still got a couple of more trading days next week for the end of the quarter, and then maybe it creeps into early part of next year and we could get that 95 target in silver very, very short order. The dollar, we think, while everyone else is bearish, we are contrarianly bullish on the dollar. We think dollar could have significant upside in the next several years. We think it's climbing along a nice rising channel. It's also potentially forming a cup and handle where a break above 115 measures all the way from 70 to 115.45. Add that to 115, that's 160, which is close to where we were in the 1985 peak, is where we think dollar could be headed. So we are very bullish on the dollar. We think this is a great pullback, testing a key support level at the 96, which also happens to be the golden cross of the 50 period above the 200 at that 96 level. It exactly rebounded from that 96.22, and from this convergence this would be a perfect point for it to rebound and start climbing higher, is where we think dollar could be. So a contrarian move would be an upward moving dollar in 2026, unlike what many are thinking. If any, we are bearish on commodities. We think commodities will continue drop into 2026 and beyond. So this has been from a CRB index, kind of topping out here at the 300 level and could resume a decline. And if that breakdown happens from 329 to 258, we're talking about roughly 70 points or so. Subtract 70 from 258, we're talking about 180, which is where we have been at the 2001 lows. It's key support 180s here in the 77. So that's where potentially we think the CRB and this PPO bearish cross is setting us up for the downward move. And we know that in the CRB, big part of the energy, we know energy has been trending lower, agricultural commodities have been trending lower, but the other two that are less than 20% of CRB is the precious metals at 7% and about 13% is the basic materials, the nickel and so on. So nickel, copper, and so on. So those aluminum. So we feel that there's going to be downside overall in commodities, and we would not be looking for additional gains beyond once silver achieves its target somewhere near the 195 level, and gold perhaps could test around number 5,000 that many bulls are looking for. So almost at 4,500 already at ounce. Another 500 get to 5,000 was quite possible in gold in the near term. And then from the CRB's bearish cross, expect downward kind of decline in commodities. Uh, the forecast for Wall Street is very bullish, continues to have upside. Savita Subramaniam is the least bullish at 7,200, but everyone else is closer towards 8,000, and the average is more towards 76 to 7,700. We feel that S&P technical indicator market breadth is indicating weakness. We think that we could be seeing a drop of percent of S&P stocks above its 200-day moving average is already printing lower highs as S&P is printing higher highs, which we call is a negative divergence. We expect this to break down into first half of next year. I wouldn't be surprised to see a level below 20 print in the next 6 months. So we expect this breadth indicator coming down, indicating VIX also potentially could have a higher move. We are testing a lower low in VIX in the 13 handle with the MACD in this case printing a higher low, which is positive divergence. Expect bullish cross of the 50 above the 200 like we saw in the 2022 time frame. So we expect, and in that case, we could see that the VIX traded in a top band from anywhere down in the 18 in the highs and 36 to 38 in the top. So we expect that kind of a 2-year time frame, 26 into 27, VIX maintaining an upward bias in that 18 to 38 range is where VIX could be trading in. VXN, in a similar way, look at how it also had a bullish cross in the 2022 timeframe. It's also setting up for the 50 period to go above the 200, a bullish cross in the VIX for the NASDAQ 100, VXN, and that could imply that we could see in a similar kind of 18 on the low to 44 on the top is that kind of an upward move in NASDAQ volatility for the next couple of years. And with that, S&P is kind of a dome-shaped topping pattern, negative divergence with the lower highs in RSI, similar kind of dome-shaped topping pattern in QQQ with lower highs in RSI and QQQ's chart, indicating potential downside into first half of next year. The downside measured targets of 636 to 580, that's 56 points. Subtract 56 from 580, we're talking about 524 is where this could come down to. S&P's downside from 6520 to 6900, 6950, 450 or so, or if that drop from 6520 could take us to 6100 to 6000, around that level is where the downside on S&P could be. On the bullish side, there could be this inverse head and shoulder from the 6900 to 65,400, add that to 69, 7300, 7285 in fact is the measured target. So that's kind of potentially possible on the very bullish side, that we could see a 7300 top in S&P, and on the bullish side in the QQQ a top from 580 to 628. You're talking about 48 added to 628, 676 potentially a top in QQQ. With that, good luck investing. Next video will be on beginning of the new year in 2026. Wishing everyone a very happy and prosperous holidays, and talk to you all next week. Thank you.